Hi everyone, welcome to this week's Advisor Market Update. September opened with a reality check that separated momentum from fundamentals. From activist pressure creating value catalysts to bond yields testing equity valuations, this week delivered clear signals about where capital is rotating and why. Let's dive into what matters. Let's start with individual company moves that signal broader themes. PepsiCo jumped 4% after Elliott Management disclosed a $4 billion stake. This isn't just about operational efficiency. Elliott sees significant upside through strategic divestitures, supply chain optimization, and capital allocation improvements. Their timing is strategic. Consumer staples have underperformed as investors favored growth, creating an opportunity for activists to drive meaningful returns through operational excellence. This signals renewed institutional interest in defensive sectors where fundamental improvements can generate alpha regardless of market direction. September began by delivering a reality check, with the Dow falling over 400 points in early trading. The sell-off hit large-cap tech and growth stocks particularly hard, triggered by surging bond yields and renewed tariff uncertainty. This wasn't just profit-taking. It was a fundamental repricing of duration risk as long-term yields approached 5%. The market's reaction demonstrates how quickly sentiment shifts when macro conditions change, reinforcing the importance of defensive positioning in growth-heavy portfolios. Now, let's examine the broader economic landscape. The Nasdaq declined 1.3% as long-end Treasury yields rose to near 5%, creating immediate pressure on high multiple growth stocks. This dynamic is particularly pronounced in software and semiconductor names that command premium valuations during the low-rate environment. Despite strong earnings growth, technology companies remain vulnerable to rate-driven multiple compression. For portfolios overweight technology, this environment requires careful attention to quality metrics and balance sheet strength. Yield curves steepened as markets prepared for $55 billion in investment-grade bond supply. Long-end yields rose while front-end rates declined, reflecting both technical supply pressure and fundamental concerns about longer-term fiscal dynamics. In anticipation of potential policy changes, corporate treasurers are accelerating issuance, adding pressures to markets already weighed down by supply and uncertainty. For fixed income allocations, this favors shorter duration strategies and high-quality credit selection as spreads are likely to widen under the weight of new issuance. Investor sentiment has notably shifted to the defensive as political policy risks resurface. The confluence of tariff rhetoric, Federal Reserve uncertainty, and political volatility is driving action across asset classes. Asian markets weakened on trade concerns, while gold briefly touched record highs, reinforcing this defensive rotation. This represents more than temporary risk-off positioning. It's recognition that policy uncertainty can quickly overwhelm fundamental support for risk assets. With these dynamics in play, let's look at where opportunity is emerging. Keurig Dr. Pepper, Charter Communications, and Hormel Foods have all reached technically oversold levels, yet analysts maintain constructive fundamental outlooks with upside targets of 25 to 50%. These represent tactical opportunities that emerge when broad-based selling creates dislocations between price and value. Each company maintains strong competitive positions and cash generation capabilities that should support recovery once sentiment stabilizes. All in all, these names illustrate defensive yield with upside potential, making these oversold conditions possible attractive risk-adjusted entry points. So what are this week's signals telling us? Company moves reveal both activist catalysts in consumer defensive and consolidation opportunities in industrials. The macro picture shows markets grappling with duration risk as yields approach 5%, while heavy corporate issuance creates technical pressures on credit markets. Defensive sentiment is rising amid policy uncertainty, creating tactical opportunities in quality names that have been oversold. Thanks for watching, and we'll see you in the next update.